Hi, everybody. Welcome to the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a very special guest here with us, Yonah Weiss with Madison Specs. And he is a cost segregation expert. And I've actually personally used his company, and he helped us save tons of money on our taxes in a very short amount of time. And he's also a pretty big influencer on LinkedIn and real estate investor himself. So for today's episode, we want to understand what cost segregation is, because that word gets thrown out a lot without too much meaning behind it. And we want to really dive into some of the details of a cost seg, like bonus depreciation and hyperamortization. So we want to have Yonah speak to that and how to reduce your upfront income tax costs and lower your cost of capital and improve your cash flow through the ability of these write-offs that you're able to get through cost seg. So Yonah, I appreciate you coming on the show, and I'm really looking forward to hearing from you.
Thank you so much, Anthony. It's really a pleasure to be on here. It's something I enjoy very much, sharing the knowledge of cost segregation with the world, and happy to do so for you and your audience as well.
Great. So what is cost segregation? Let's just start there.
It's a really weird name. Okay, that's what it is. But it's a really weird name for something the IRS gave to probably one of the greatest income tax deductions that exists. Okay, so we'll break down the word cost. When you buy a property, you're allowed to write off the entire value of that building. The entire amount that you spent, you're allowed to take as an income tax write-off, okay? A deduction called depreciation. Now that deduction lasts over a long period of time, and it's all lumped together, okay? You take that whole amount and you take it as a write-off over 27 and a half years, okay? Or 39 years for commercial properties, except for multifamily. Multifamily is still considered 27 and a half residential. Now, cost segregation means just we're segregating, we're breaking out the cost that you spent into different categories. Okay, we're basically taking, and instead of depreciating the entire building as one, we are doing what's called component depreciation. We're looking at the building, not only as the building, we're looking at the structural components, which depreciate on a longer period of time, 27 and a half years. We're looking at the land improvements. So that's anything outside the building, like landscaping, pavement, fencing, etc. And 5-year property, and that depreciates on a 15-year, schedule. So that's faster. And then you have personal property or tangible, movable property that's inside the building, not part of the structure, depreciates on a 5-year schedule. That's anything like, appliances, furnishings, carpeting, floor coverings, window treatments, you name it, anything that's not part of the structural component. And, cabinets or countertops, all that stuff is really valuable. We take the cost of those values and we depreciate them all on separate levels, separate playing fields, so that we can maximize your deductions earlier on. So that's cost segregation in a nutshell.
Awesome. That was a great explanation. And you mentioned IRS tax code. When did these new laws go into effect to help, streamline this process and make,
Sure.
Be having the ability to depreciate quicker?
Well, it's kind of been developing, but it first came into the books a little over 40 years ago. So we're talking in the 70s was the beginning stages of cost segregation. And again, it used to be called component depreciation at that time. And there weren't many laws about it. Only in the tax reform during the Reagan administration really took a lot more form. And over the years, there have been many court cases, many, tax law has been developed over time, and different things added to the books to kind of make cost segregation what it is today. But certainly for the past 10, 15 years, there haven't been tremendous changes except for one. And that one maybe we'll talk about a little bit later on, was with the Tax Cuts and Jobs Act 2 years ago that had a tremendous effect with the law called bonus depreciation.
Sure. And so as we talk about these things, in terms of asset classes, you can use cost segregation on anything, right? But multifamily, as you mentioned, is a little bit shorter life than an office building or an industrial facility.
Correct. Yeah. Any type of property can have the benefit. As we're going to look a little bit more at what cost segregation is, how it works, and how we're breaking down property into personal property, land improvements, building structure, et cetera, have different lives. Each type of commercial property will have different, values or percentages that we can actually accelerate the depreciation and take the faster depreciation. So, you mentioned multifamily is a great example. It's a very popular asset class. Typically between 20 and 30%, sometimes more, sometimes less, of the actual building value can be accelerated to those faster categories and taken as a faster write-off. So again, we're front-loading those depreciation deductions instead of spreading them out and taking a little bit every year. We're taking a huge amount during the first year or first 5 years. But other properties like office, industrial, retail, they'll all have different categories because there's different types of personal property in each one of those, and all of those are priced out and valued at different amounts.
Sure, that makes sense. So you mentioned a little bit on bonus depreciation and how you're able to write off those different categories. Basically, when you bought the property, can you just explain why that would be advantageous to an operator? Because, there's something called depreciation recapture. Can you kind of talk about that as well?
Absolutely. So we touched on a couple of things. First thing is what's called 100% bonus depreciation. This came into law in the Tax Cuts and Jobs Act of 2017, 2018, which essentially says that any property that depreciates under a 20-year period, which is all of the stuff that we are recategorizing in the cost segregation study, once you get that cost segregation study done, you can opt into, it's an election, it's something you can choose to do, to take all of that depreciation, 100% of those deductions in year number one. So instead of spreading it over a 5-year or 15-year period, those extra deductions, you can actually take them all year number one. Why is that advantageous? It kind of goes without saying because you're having huge tax write-offs in that first year. If we're talking about a 20% write-off, you buy $1 million property and just multiply this by $5 million property, you're taking 20%, $200,000 approximately. And there's always going to be a land allocation. I didn't mention that we're not depreciating that amount of what's considered land. However, it's still going to be approximately 20%. That means a $200,000 tax write-off in the first year. If you think about that, maybe you put a down payment to finance this property for $200,000. You got 80% financing. That means the entire amount that you actually paid out of pocket, you can now take as a first-year tax deduction. Now that's huge because that's certainly going to cover any of the income from the property and make sure that all of the income that you're making is not going to be taxed. Now this is certainly advantageous for someone who is a real estate professional. This is someone that by tax law is considered someone who spends more than 50% of their time, the majority of their time, materially participating in the real estate trade or business. So if you do that, you now basically have like this golden ticket. With the tax law, it allows you not only to take those depreciation deductions and offset your income from your properties, but also to now use those deductions to offset any of your active income, you or your spouse's active income. So you may be a real estate investor, you may be a property manager, a broker, and you're making great commissions. You can use those depreciation, that extra $200,000, and knock off the income tax that you would have had to pay on your regular, ordinary income.
Makes a lot of sense. And talking about it from the passive investor's perspective, how are they able to allocate the write-offs? Are they able to offset that against their income? Or if they're not considered a real estate professional, does it not apply as much? How does that work?
So it's not going to apply as much, as I mentioned, if they're not the real estate professional. However, this is always going to be used to offset your personal, the property income or any properties. Because let's say you own several properties, the depreciation created from cost segregation is going to be able to offset all of that income. So for the passive investor, unless they're a real estate professional, and unless not only are they passive here, but they actually have to have there's a certain threshold. If someone is simply passive and they have no material participation, there is a certain threshold that they need aggregated across, other properties to actually be invested in that, to get the benefits outside of the income from the property. So they're always going to be able to use this against income from the property. Let's say you're a passive investor and you're getting returns of, $10,000 a year, and your depreciation deduction allocated to you based on your percentage of ownership is going to be $10,000 or more. Then you've essentially made that money and it stays in your pocket, which is almost unheard of in any other type of investment vehicle, which means that you are not only getting the returns on your investment, but you're not taxed on them. Okay. So if you are a real estate professional, and again, as I mentioned, this is more a question for your accountant, your personal situation, but you may be able to actually use that to offset your active income or your spouse's active income as well.
Yeah, especially as you mentioned, if they're working on a 1099 or they have a non-W-2 job. For W-2, forget about it. But again, we're not CPAs, but
right.
In my experience, it's been challenging there. But 1099 is kind of a gray area. So with this cost segregation, and you mentioned the Tax Cuts and Jobs Act, which was passed a couple of years ago. We're recording this right now towards the end of May 2020, early June, and we have an election coming up. Now, if it swings the other way, do you still anticipate that there's going to be some form of cost segregation and this depreciation to survive and live on? Because like you said, it's been around for 40 plus years. What are your thoughts on that?
Yeah, people like to think that it was only because Trump, came into office and he was a big real estate investor that put this law in the books. And the truth of the matter is that may have had something to do with it, but believe it or not, whether you like it or not, 80% of Congress are, invest in real estate. So they have a vested interest in making sure that real estate gets the best deductions, which is kind of, you may consider that, I don't want to get into politics here, but there's no way that this is going to be outlawed. Cost segregation is going to be outlawed. There may be other things that come into effect that might affect it. Maybe. Certainly the bonus depreciation, according to the current tax law, is going to start to phase out in 2023. So the 100% is no longer going to be available in 2023. It's going to go down to 80% bonus. And then it's going to start phasing out from there down to 70, 60, et cetera, until it's back down to zero, unless that changes as well. If someone else comes into office, they may try to push other things. But again, I highly doubt it, because it's not just the president's decision. This is something that has to pass, in Congress. So that's my view on it.
No, that makes a lot of sense. So what can you anticipate? And maybe it's an offline question, but I thought I'd share this with the audience too. The cost to do a cost segregation study, is it typically? I mean, the ROI seems pretty significant. At least it was for me. I guess, does it depend upon the size of the building? Like how are the studies priced? And also a follow-up question, when you do the study once, do you have to do it again? Or is it only a one-time study?
Excellent question. So the way it's priced out is based on the scope of work of the property. So this has nothing to do with your actual tax savings, not contingent on the amounts that you're going to make on it. Although I have heard there are certain companies that charge on that type of basis, which to me is kind of ludicrous, because they're no longer considered third-party, agents. They kind of have a stake in how much they're telling the IRS you can claim, which is kind of monkey business, if you ask me. Now, where's the threshold that it makes sense? Since we're talking about like percentages of depreciation, okay, 20% of $1 million, $200,000 extra deductions, it makes sense. So, to pay a few $1,000s. Our prices are anywhere usually between $4,000 and $10,000, depending on the size and the scope of work of the property is pretty typical. And that's obviously as of now of the airing of this episode, but you are going to want to look at it. I think any property purchased for over $500,000 is definitely worthwhile to look into. Over $1 million, it's like a no-brainer, but that's the threshold where I see there's really benefit there. And it really makes sense just that at the very least to get a free estimate, because that's what we do. We'll send you a free estimate and show you the numbers. Hey, this is what you're going to save on your taxes if you do a full cost segregation study. It's going to cost you X amount of dollars. Does it make sense? Does it not make sense? Should, obviously discuss this with your tax advisor. Now, the follow-up question was, do you have to do this and update it every year? No, the answer is no. This is a one-time thing. And the amazing thing about it is depreciation, as I mentioned at the beginning, is based on the purchase price of your property, okay? The day that you buy it, which to me is one of the most baffling things about the tax code and depreciation in general, is that it's really like a hypothetical deduction. Meaning, what I mean by that is that depreciation means something's going down in value, right? So you're allowed to take a write-off of the amount of your property based on the principle that things go down in value as time goes on. However, you start that date and you start that price the day that you purchase the property. So even you're buying a building that was built in 1937, okay? Guess what? You get to start over at the day you buy the property. Your depreciation schedule, that 27 and a half years, starts over from the day you buy it. And you go ahead and sell that property 5 years down the line for a profit, and the new guy buys it at $5 million. He's now starting his depreciation from day one. That 27 and a half year schedule starts over. And so he needs to now go ahead and do a cost segregation because the schedule is different. The pricing is different. However, that's why I think of it as like a hypothetical kind of deduction, because it's not really based on the real value, of the building. You would say the whole thing was built in 1937. It's totally been depreciated. There's no value left to it. It's totally gone down in value. No, that's not the case, which is incredible to me. However, there's one case where you would need to get an update on your cost segregation study, even as the same individual owner of the property, and that's when you were doing major renovations or additions to the property. So any money that is spent on the property, and doesn't have any money out of your pocket, it can be totally financed. It could be the bank's money, right? And you spend $1 million, to update your property, put in new kitchens and a new parking lot and et cetera. You can now go do a cost segregation on those improvements because that money is now depreciated as well, and you get the tax write-off based on that.
Yeah, no, I've experienced it firsthand, and actually that second phase you talked about, I'm about to explore. So kind of winding down the show a little bit, another question that I would have is, what would make someone not want to do a cost segregation? Whether they're so what I do is mostly I syndicate. So, when we do end up selling the property, whether that's 3 years, maybe it's next year, maybe that's 5 years from now, we're going to have to, obviously recapture all the write-offs that we've taken, but that's through proceeds of a sale. Have you seen operators just not even bother with cost segregation for maybe personal reasons, for investors, or what? Is there anything?
Sure.
I can't really think of too much besides.
There are a few reasons.
Yeah.
There are probably a few reasons why, one would consider or would not consider it. I think one thing obviously you have to take into consideration is the depreciation recapture tax, which means that when you sell a property, not only do you have to pay a capital gains tax on the gain that you made upon the sale of that, but you have to pay a recapture tax, which means that you pay 25% tax based on the amount of depreciation that you took. So taking extra depreciation will potentially cause you to pay more tax than you would have had you not done the cost segregation study. So that obviously needs to be taken into consideration in the entire overall business plan. There's still tremendous ROI, usually because of the amount of what's called the time value of money, the amount of the cash flow and the money that you have during that time between purchasing and selling the property. That's one thing to consider. Another thing to consider is that let's say there are people or investors who are not taxable. Okay, so a perfect example is that is someone's investing from a retirement account. Okay, a Roth IRA or 401k account is not taxable. Therefore, if they're putting money in, which is a great strategy in many, in its own regard, if done properly and done with the right guidance, you can actually invest money from your retirement account into real estate investment. However, if you are not going to benefit from that depreciation, so the operator or the syndicator may want to consider, hey, should this be done? Should it not be done? Because again, I'm creating all these depreciation deductions and it's going to be spread out according to the percentage of ownership. And if those investors cannot benefit from that, then maybe it's not worth doing in the first place.
So my one last question, my one last question would be, your clients have any strategies to still avoid paying the recapture tax and the recapture in general, whether that's through 1031 exchange? Because I mean wouldn't that provide you the ability to exchange it to something else and not have to worry about that? Or like how does that work with the exchanges?
Absolutely. Yeah, there are a few ways to get around that. And obviously that's one thing to consider why people might not want to get it. One thing, as you mentioned, is a 1031 exchange. If you are exchanging the property through the 1031, you are further deferring the depreciation recapture tax as well. So that's a perfect way to kind of defer that down the ride. In a syndication, it's a little more complicated. In order to 1031 exchange out of a syndication, it can be done. It's a little more legal, legwork to make sure that can be done. There are a couple other ways as well. Number one is what's called a partial asset disposition, which is something a lot of people don't know about. But it means it's a form that you file upon the sale of a property or anytime you're actually disposing of any assets in the building, and you're basically writing off that value from the basis, from the depreciation of that property. So let's take a great example. Let's say you put in all new cabinets, put in new kitchens, appliances into your property, and you spent $50,000, on that. Now, when you spent the $50,000 to put in the new assets, again, as we mentioned before, that's put onto the basis. You're not going to depreciate that. But what about the stuff that you threw out? What about the old, sinks, the old appliances? You can now actually write that off from your books and say that no longer has any value to it. I'm writing it off. When you sell a property, you can do exactly the same thing. You can say, hey, I've held this property for 5 years. And during that 5 years, I did cost segregation. And cost segregation says that this 5-year property, that personal property that depreciates in a 5-year schedule has already, from a tax perspective, has been already written off, which means it no longer has any value or little value to it, which means I can write that off, filing a special form upon the sale of the property, not necessarily written into the PSA. It's not something that's going in and saying, and this can be done, so people do this, but it's not necessary. It's not what I'm describing here, that you're just saying these appliances, these, furnitures and fixtures, et cetera, have no value to it. Therefore, I do not pay recapture tax on what does not have value to it. So you're only going to be left with potentially the amount of depreciation recapture tax on the structural components that you would have had to pay anyways had you not done the cost segregation. So that's another a little more complicated strategy. It's something that a lot of accounting firms use. I know, for example, all of the big four, all of the major accounting firms use this strategy. So it definitely can be done. A little more work. Another way to get around this is, and this is more for the real estate professional than anyone else, because as I mentioned before, you can use those losses to offset your other gains or your other income. If you have more losses than you have income, okay, meaning you have more deductions than your income, you create a loss. And that loss is carried forward with you. I mean, you can use it next year, you can use it the year after. What happens when you sell a property? So those losses are released. If you have extra losses, guess what? Those losses can not only be used to offset your income, because again, we've covered all our income tax. You're paying no income tax. Any extra losses at that point upon sale can now be used to offset your depreciation recapture tax and potential capital gains tax. So that's a way really for the real estate professional to plan accordingly and buy more properties in the year he's selling this one, so that he can create extra gains now. And again, this is an overall real estate tax planning strategy, but it can be done in order to get, maximize those deductions and maximize the way that you can actually get around even paying the recapture tax.
Really interesting stuff. Really, we got to talk offline.
Yeah. Well, again, this is more for everyone in their individual situation should be, speaking with their tax advisor to make sure that you're doing this properly.
Absolutely. We can't stress that enough. Great, Yonah. So we're going to wrap this up, and I usually ask just 3 quick questions at the end of each show. First question would be, do you have a favorite business book, in your life that helped you get to where you are today?
I love the book 10X, the 10X rule, Grant Cardone. I don't love the person so much, but I think it was very educational to me, eye-opening in order to focus in business and focus in marketing in particular, because that kind of showed me kind of new way to look at business and the hustle and the marketing efforts involved in really focusing and growing in a business.
Sure. Yeah. Well, I still have to get my hands on a copy of 10X. And as
you
far as
you either love it or hate it.
Love it or hate it. Well, I actually like
it's one of those.
So we'll see. And in terms of, you have any role models? Is obviously as a person, like Grant, but any role models in business that you kind of look up to?
In business, I look up to very much I have a good friend who is kind of like a mentor to me, and I've had many mentors in my life, but this friend kind of pushed me in the right direction at the beginning when I started getting involved in real estate about 5 years ago, and was someone that, he's not online so much. He's someone that is kind of quiet. He stays behind the scenes. Has a huge, real estate company, owns hundreds of millions of dollars worth of properties, and is a nationally kind of known, recognized figure in the commercial real estate industry. And nevertheless, he, took the time to sit down with me on many occasions and just to kind of walk me through some things and push me in the right direction. In fact, he used Madison Specs for his cost seg even before I knew of Madison. And so he was very happy to kind of push me in that direction and say, this is a great company, great people. You're going to be in good hands if you're working with them.
Awesome. And the last one was, what are your hobbies outside of cost segregation?
I love helping people. I spend a lot of time on LinkedIn. I don't know if you can call it a hobby, but actually I spend a lot of time helping people. And so what I do is I set up like these challenges where I get a lot of other people in the commercial real estate industry to just push themselves beyond their comfort zone and push themselves to start creating content and putting themselves out there. And so it's kind of a hobby to me because I'm not making any money from it. I don't have a LinkedIn marketing business, but I enjoy it. I really enjoy helping people, and it's a lot of fun just sharing my experiences and sharing the knowledge that I've found from that.
And it pays back. I'm sure you've seen it.
It definitely pays back. Yeah, for sure.
Awesome. Well, Yonah, again, really appreciate you coming on the Discovering Multifamily show. How can people find you?
LinkedIn. Check it out. You can also check me out, my new podcast, Weiss Advice, launching next week. So anywhere you're listening to podcasts, you can check that out.
Yeah, definitely. When he releases that, subscribe and, give him a 5-star review and give him a solid rating, because it helps, all our podcasts get seen more in the general public, and, help everyone and get our message and get our word out. So again, Yonah, really appreciate it. We're going to have links to Yonah's LinkedIn and new podcast, hopefully, in the comments section of our show. And feel free to reach out to him, reach out to me to get to him, or just reach out to him. Very easy to get to. And again, Yonah, I really appreciate you coming on. I'd love to have a follow-up show with you, hopefully next year.
Awesome. Yeah. Thank you very much. I would love to.
Great. Thanks again.